February is historically one of the weakest months for markets, but weak months present buy the dip opportunities. Right now, what's holding back the bull market is trade war driven inflation. But this is not 2018, the macro setup is completely different. In this video, I'm going to walk you through why inflation concerns are overblown and why the macro conditions are setting up for a positive surprise. First, we're going to start with investor sentiment indicators. For most of 2024, 75% of stocks were trading above their 200 daily moving average. Today, that number has dropped below 60%. The number of stocks hitting fresh new 30-day highs has cut in half since January. Weekly sentiment surveys suggest investors are becoming less bullish and more bearish. High beta stocks are no longer outperforming low beta stocks, and crypto is underperforming the S&P. And when we add these sentiment indicators together, this is a clear sign that risk appetite has fled the market. But what if I told you this is a good thing? As sentiment gets worse, greed is washed out of the market, all while the macro conditions have improved. And this is what I like to call bullish macro divergence. In other words, the setup for a positive surprise is around the corner as long as tariffs don't turn into a trade war. And because trade war driven inflation is at the top of investor concerns, all we need to do is pay attention to the bond market. Because the bond market sets long-term interest rates, which includes mortgage rates and corporate borrowing. And so far, the bond market is not worried about inflation, evidenced by rates declining since Trump first announced tariffs. Stable rates serve as a tailwind for markets. As long as they can remain stable, equities and crypto continue higher. Now keep in mind the broader index can consolidate while specific sectors, themes, or industries show significant strength. For example, Tempest AI is up over 100% since being called out on the Discord in January. Thank you, Nancy Pelosi. Cybersecurity themes like Okta and Cloudflare both up over 10%. Nuclear technology companies like Oklo after being Signal up over 50%. We also have HIMS, which is up over 100%. So while the S&P has gone pretty much nowhere since November, individual stocks continue to soar. The outperformance of individual stocks is a prime example of bullish macro divergence. Now let me explain overblown inflation concerns. Some people argue inflation is set to reaccelerate because headline CPI is rising, but key components, shelter and energy, are actually declining. To me at least, this reflects CPI strength as more reflective of a stronger than expected economy than underlying structural inflation. The real outlier here is transportation services, mostly car insurance, which is hurting consumers but not enough to trigger a market panic. And if we use common sense, insurance prices are not going to spike all of a sudden. If anything, they actually slow down the consumer. A true inflation shock would require oil prices to spike, and that's just not happening. So in my view, this bump up in inflation is likely to roll over in the near future. So with stable rates and tame oil prices, the macro backdrop remains bullish. Now let me explain why the cyclical segment of the economy is about to drive another bullish trend in the market. Manufacturing is the cyclical part of the economy, and it's been in a recession for over 2 years, but now starting to rise from the ashes. The ISM manufacturing cycle represents the capital intensive part of the economy, and recently it surpassed a level of 50, which means we're in expansion territory. Rising economic activity means rising GDP, which means rising earnings growth. So like we talked about earlier, as investor sentiment is near depressed, the cyclical economy is starting to rise. Within the ISM, you have different components, and the new orders component is basically forward-looking GDP. And we just saw the highest level since May of 2022. Risk assets like Bitcoin love a rising ISM. You pretty much have to be blind not to see the correlation. So again, a rise above 50 signals an industry expansion. Could it be inflationary? Sure, but that's why we look at ISM prices to track inflation when it comes to supply chains. You also have artificial intelligence and the Doge boys, which are very deflationary forces while the cyclical part of the economy starts to expand. The next bullish macro driver is liquidity. In 2021, the bull market was fueled by Fed liquidity. Today, Fed liquidity isn't a driving force, yet markets continue higher. Why is that the case? Because another source of liquidity magically appeared. Now, coincidentally, the market bottom bottomed in 2022 as this other source of liquidity began to flood into the market. And this was RRP, reverse repo liquidity, or cash that was building up on the sidelines all of 2021 and released back into the market in 2022. The problem is that the RRP is nearly empty. Most of that cash has already been depleted. But now we have a new source of liquidity taking stage. The Treasury General Account, the TGA, is fiscal liquidity. The TGA is essentially the government spending account. And right now it's loaded up with over $800 billion. After tax season, this figure is expected to grow even further. Historically, TGA spending has provided a boost to markets. If we look at 2017, we saw the TGA spending help give markets a boost. When that spending stopped, markets weakened. But keep in mind, the Fed was in a hiking cycle opposed to today. The Fed is in a cutting cycle, so we're in much better territory. Now, at the end of 2021, we got the same weakness in markets when TGA liquidity dropped off, and again midway through 2023. And this is opposed to when that spending accelerated. You can see the support in markets. With the government spending account sitting pretty fat and tax revenue starting to come in, we can expect the Trump administration to start stimulating the economy, therefore markets, in the next couple months. Look, it's really only a matter of time before we start to see what Trump wants to spend. And let's say the economy weakens before that, well, the Fed has enough room to cut rates. Either way, the macro is set up for a vicious 2025. Here's a little more macro to give you confidence. So some people made a fuss about the retail sales because the month-over-month data came in negative for January, but that was actually a good thing because it cooled down rates, and that's exactly what we want. But if we look at the annual trend of retail sales, it looks a lot better. It looks like it's still starting to pick up. And if we add in ISM manufacturing picking up and Trump starting to stimulate, cut rates, deregulation, well, we can expect retail sales to continue higher. We also have business optimism picking up, which means more activity, more loans, more financing, more spending. And for the first time, we saw a big bump up in industrial production, which is part of that manufacturing sector. Everything points to capital intensive activity accelerating. Now, although we do see GDP growth slowing, remember it's a lagging indicator. The leading indicators are actually showing life. ISM manufacturing picking up, industrial production picking up, retail sales picking up, and unemployment surprisingly showed a positive signal by actually falling. That usually doesn't happen once it starts to move up. And like we talked about with inflation, it looks bad, but remember that's also a lagging indicator. Supply chain prices, shelter prices, and oil prices are giving us the opposite outlook. The downside is obviously a global trade war, but so far, Trump's tariffs have been pretty strategic. Negotiations are open, and that's what the market wants to hear. Now, there will be tariff volatility, but so far it looks like Trump is listening to the market, not implementing tactics like we saw in 2018. Treasury Secretary Scott Bessent understands they can't control the Fed, and they're focused on getting the 10-year Treasury lower. And that's what DOGE is for, eliminating wasteful government spending. If the government is more efficient, then you get less inflation pressure, which adds on to the bullish narrative. More importantly, can they get OPEC to increase production and get oil prices lower? That's probably going to take another negotiation. But at the end of the day, the lifeblood of a bull market is rotation. Sometimes we see mega cap growth stocks take the lead. Sometimes mid cap value stocks take the lead. Sometimes it's pure thematic momentum. And if there's fears of the economy slowing, we're going to see defensive stocks take the lead. Either way, it's all rotation within a bullish macro cycle. We know this because the manufacturing cycle is rising. Global central banks are in a cutting cycle. We're looking at deregulation and tax cuts, and hopefully we can get energy prices lower.